What's up, everybody? My name is Jason, and welcome to Small Biz. It is Friday, TGIF, March the 10th, 2023. In today's video, I'm going to talk about how the Fed is wrecking the banking system, why SIVB just got shut down and halted by the FDIC, the ripple effect that's having in other regional banks, including Charles Schwab, which is down more than 30% this week, and last but certainly not least, what effect, if any, is this going to have on the 5 or 6 stocks that we currently own right now? So all that and more coming right up. All right, ladies and gentlemen, this is going to be a jam-packed video. We're just after 12:30 in the afternoon. The markets are starting to slide. I have a theory as to why that is, relating to margin calls and other regional banks that are currently in trouble. I will cover this in great detail, but let me start by saying thank you to hundreds of new subscribers on YouTube and the folks at Google who have more than doubled my reach from 500 to 1,000 views a video in the last couple of weeks because, in large part, I cleaned up most of my swearing, not all. I've still got the beeper. And I cut out the constant references to alcohol, which, according to Google, including violence, is frowned upon, shadow banned. So, if you're new, welcome. Make sure you follow me on Twitter at TrySmallBiz. I talk about stocks, what to buy, what to sell, why the market's doing what it's doing all day long. And while we have suffered, along with everybody else, some drawdowns here in the last few weeks, we have made an absolute fortune. So follow me on Twitter in the last 12 months. Over 100 winners, by the way. I know, haters, it's hard to get away from that. Over 100 winners, average gain 30% in about a month. And get a premium membership at TrySmallBiz.com. SVIB, Silicon Valley Bank, was shut down after getting halted this morning by the FDIC. And over the course of this video, I'm going to explain how I used to be in the brokerage business, why the same thing happened to us, and why the glass is half full because the feds are getting out in front of a problem before it becomes a catastrophe, as was the case in 2008. Allow me to explain. In a prior life, and I've been trading now for 30 years, I was a stockbroker for 15. And I was part, in the latter half of my career, of a firm that was based in LA. I was in South Florida, and they had a huge position in CMOs, mortgage-backed securities. And the same thing happened back then that's happened right now. Interest rates started going against us. I never partaked in that stuff. I was big into options. Again, as I said yesterday, I'll explain in a future video how I went bankrupt and why they're very dangerous and you need to be careful. But the LA office in particular had a massive, I think it was close to 50 to 100 million of mortgage-backed securities. And when the housing market, as it is now, is starting to crack, the feds came in through Fidelity, who was our clearing firm. They said, you need to market these assets, and you need to do it right now. Well, if you saw the movie The Big Short and Margin Call, the bond market is many times the size of the stock market, but it's often in certain pockets illiquid. And when they say mark to market, it really means, what the hell is this shit really worth? Well, the same thing happened to SVIB. They were taking money in through inexperienced money managers over the course of the last several years with rates at zero, and they put a ton of their assets, their funds, into treasuries from, 6-month bills all the way up to 30-year bonds. And as interest rates have gone from 0 to 5% in the 10-year, in the last 12 months, the highest, fastest rate cycle in Fed history, these inexperienced money managers who got way overloaded in treasuries at the wrong time, when forced to market, suddenly their assets at the bank were worth half, if not less, of what they're really worth right now. So they tried to do an offering. I think I saw GE was involved with that. Stay away. The stock dropped another 50% overnight. Then they halted the stock, and the FDIC realized we've got a big problem here. So they shut down the bank quickly. In my opinion, the smart move. Because as you're seeing right now, as I shared on Twitter, you've got WAL and FRC, regional banks, that are down 50% in the last 3 days. There's a run on the bank. You've got Peter Thiel and others telling people, take your money out of regional banks. Whether that's a smart move or not, I'll leave that up to him and others to say. All I'm telling you is the fear is starting to go through the roof. I've shared the fake news fear and greed index when it was 79, and I called a top on the S&P at 4182 when Jim Cramer said we have a, quote, brand new bull market. I said, we're topping out here at 79, and I said we were going to go to 35. If you saw the photo I shared on my wall yesterday, where was it? 35. Right in the middle of the fear zone. Well, now we're at 25. And we may be going to extreme fear over the weekend as the Dow is approaching down 300 because, number one, we're going to find out it's more than SIVB. And number two, we're going to have a problem with panic from retail. And number three, margin calls. So I expect the close on today and the open on Monday, unless the Fed comes out, to be nasty. And if you've been following me on Twitter, I said the last 10% of what I called the final flush are going to be scary. We're already 90% of the way through this meltdown. We've already had the average stock, including XELA and HLBZ, two of which I'd be buying right now. You can get XELA in the 5s and HLBZ at 12.5 right now. Screaming buys. Both of them are down 99% plus from where they were a year ago. But as you have this retail panic amidst the final flush, and you get the headlines of other banks that are closing, including Charles Schwab, I don't quite understand that one, but we're going to find out they probably have way too many treasuries, is down more than 35% in less than a week. You're talking about a premier discount broker, one of the best, if not the most recognized in the entire world. So yes, we've had a 20 to 30, 35% drawdown in the last couple of weeks. So as some of the haters pointed out on Twitter, and you know I love you. Well, if you're so smart and you've gotten crypto, I nailed that, top at 25, said it was going to 21, breaks 21, it's going to 18, dead on. Why the hell didn't you get us out of these stocks 3 weeks ago? Fair point. But this much I've learned in the last 30 years of trading. Half the time, I'm going to be right going to 100% cash. Half the time, I would have been the golden guru. This guy made us 700% last year in over 100 winning trades, and he got us out of the market at 100% cash before shit hit the fan. But then the other half of the time, I've done something like that. Suddenly, the Fed comes out, and mark my words, they're coming out, whether it's next week, over the weekend, or at the press conference in 10 days. I believe it's the 22nd of March, and there's going to be some sort of a pivot because, as I shared on Twitter, we have gone from zero chance of rate cuts this year to almost tripling the odds of rate cuts by the third quarter. And Larry McDonald, Google that or search that on YouTube, the biggest bear in the world who nailed this correction to a T, said, because of the illiquid situation we now have in the bond market, the Fed is going to cut by 100 basis points in the third and or fourth quarter. So we have gone from zero rates in record time to 5 and quite possibly down 1 by Christmas of this year in the backdrop of all these money managers that have no idea what they're doing. It's been Fat Cat City for years. You've been hanging out in Omaha down the street from Buffett, managing hundreds of billions of dollars in treasuries at near zero rates with no risk in sight. And suddenly the Fed intentionally says, we got to bring an end to this runaway inflation. We got to wreck the economy to some extent. We got to bring it down. And if you saw the jobs numbers today, they were above expectations, but not a blowout. And we had positive readings in unemployment, which ticked up. And perhaps most importantly, wage inflation came down 2 ticks, I believe, above expectations. Combine that with a US dollar that's in free fall, even though the VIX is now north of 25, red flags are wearing, the glass is half full. So before you log off, and by the way, fun fact for you, average view time in a YouTube video is about 40%. So if this is a 15-minute video, half of you, if not more, are logging off right now. But I am going to spend the balance of this video for those of you that are still here, giving you piece by piece why the glass is half full. Dow now down 320 at almost 1 in the afternoon. Again, I would not be surprised to see us down 600 or 700 plus on fears of more runs on banks, more closures, and the big margin calls to come early next week. The VIX right now, as I'm talking to you, is approaching 26. If it gets up and over, listen to me carefully. If the VIX gets up and over 35 or 40, that is the bottom. If we get over 35 or 40, something we've had trouble doing in terms of bottoming out, even in October and December, then the low is in. 90% of it, as I've said, is over. But what do we have right now? We got the dollar down a full percentage point. That is highly unusual. That happens maybe 5 times a year. And when the dollar's going down, the stocks have a chance to go up. We've got rates down. Why? Because we've suddenly gone from an atmosphere of we need 50 basis points from the Fed in March, May, and June to, we may have to slow our roll because we've got multiple banks at the regional level that are in trouble, to now hearing some gurus like Larry McDonald and others saying we're going to have to cut rates by 50 to as much as 100 basis points to avoid another Lehman-like moment. And let me take everybody back once again to 2008. Glass half full here. Lehman Brothers went under in September. Hank Paulson, a major cutthroat, led the bailouts. And I'll keep it simple, stupid. They basically threw Lehman Brothers and Bear Stearns to the wolves. And they told Merrill Lynch, you were buying Bank of America. And Merrill says, we don't want them. You're whether you want to or not. And they handed out, I think, close to $800 billion worth of cash. Many of the banks didn't want the money, nor did they spend it. And I guarantee, fast forward to today, again, it's a mini Lehman moment. Most of the major banks like JP Morgan, which is up the last time I checked about an hour ago, they're going to benefit. If JP Morgan's not running ads by Monday morning saying, hey, have you got concerns with your local money-centered bank? Well, hey, we've got love for everybody, and we certainly wish you the very best. But if you want to bank with a leader who's got XYZ in deposits and has virtually no risk in the credit markets because we've got the smartest MBAs in the world, then send your money on over to JP Morgan. But you have a mini Lehman moment here in 2023. The Fed learned a lot in 2008. So instead of wait, I guarantee they stepped out, they shut it down, they halted the stock on SIVB. They were on the horn immediately with the regionals and many others. And one of the first questions, whether it's Jerome Powell himself or somebody from the hidden hand that's telling Jerome Powell exactly what to do, we need to know right now what's your mark to market on all your treasuries. And don't BS us, don't lie to us. We need to know right now. Because if you're in trouble, we're going to be halting your stock on Monday, on Tuesday, or Wednesday. And at the same time, I think the Fed's going to inject massive liquidity into the bond market. It's not the same as printing dollars. They're going to do overnight repos and massive amounts of liquidity. And they're going to put out, if they're smart, unless they're trying to wreck the economy. But I'm giving you the glass half full version. They're going to say, we recognize that we have a problem. A lot of the regional banks had inexperienced money managers that were managing risk at zero rates. And because we've had to go from 0 to 5 to stave off and eliminate inflation, when they're forced to market, there's a bit of a problem. We have isolated, and I would be given an exact number, 17 banks in such and such categories. Whether they name them or not, it's not important. We do not, based on extensive and thorough investigation, think the problem goes any further than this. But if it does, we stand ready with $1 trillion of liquidity to do A, B, and C. And that's part of the reason, in closing, why I am not out of these stocks, which we have suffered a 20 to 30% drawdown. Because whether it's Monday, whether it's at the press conference, whether it's before Memorial Day, at some point in the next 30 to 60 days, the Fed is going to pivot. They're going to come out and say, you know what? Wage inflation's coming down. Unemployment's ticking up. We've got commodity prices like oil and gas, and my goodness, we're not even talking about Baltic freight or the trucker index, et cetera, that's down 30, 40, 50, as much as 70%. Lumber prices, there's another one way down. Screaming inflation. We don't see any reason to be doing 50-point basis hikes anymore. In fact, we may, depending on the data, be able to stop by May or no later than June. And I'm telling you right now, as the glass is half full here in Atlanta, the minute that comes out of Jerome Powell's mouth, and even if it's the market sensing it's about to come out of Jerome Powell's mouth, you're going to see the Dow jump 2,000 points in less than an hour. And these stocks that we own that are down on a 10th XELA, buy it at 054. And I said yesterday there was a chance it was going to come down to 052, and it has. Earnings are supposed to be tonight. We'll see if they sandbag it until a better time next week. I do not know. But all of a sudden, the coast is going to clear, the sun is going to come out, and people are going to realize, holy shit, holy we're offsides. We're caught short. We got too much cash. We better get back in and cover. We better start buying these stocks like PBLA, which is going to report next week. I believe it's Thursday after the market. It's down 55%. Looks like it may have bottomed out, by the way, in the low to mid 60s. It was up at 10% in the mid 70s this morning. The stock's been cut in half on no bad news. They had a pancreatic patent that drove the stock to 148 last week, and it's fallen apart. But when the Fed rings the bell and says, we're done, or the next meeting, we're done, you're going to see a melt up. You're going to see a mother of all short squeezes. You're going to see a correction, a reversion to the mean from way oversold to slightly overbought in an instant. And if you're not in the market, the moment that happens, even though we're suffering and sucking it up on a 20 to 30, even 35% drawdown, boom, you're going to miss it. So for all you snowflakes out there who seem to get everything perfect all the time, well done. If you're actually in 100% cash and you're not buying an XELA last trade 0538 or a Hellbiz HLBZ at 12.5 and a B-Big, which I am not advising you go anywhere near, probably going into the 30s. We may be a step. There goes the thumbs down. Give me some thumbs down on that one. My fault. My bad. I never should have got back into that. I sold a third at 82.5. I screwed up. It's run by a felon who was in jail in November. Still might be there. But I'm hoping and praying because BlackRock and others bought huge amounts of stock at 70 cents that we're going to get a bounce. But if you want new money, ENSC got all the way down at 51 cents on insanely light volume. Last trade 56. I would not be surprised if ENSC closes at or near 60. But my two favorites, the ones that are 99% down that I'm convinced with an XELA that's supposed to report tonight and an HLBZ who seasonally is about to have 2 quarters, if they could ever stop printing the press, right, Sal, of very good weather, the risk reward from here on out with the Fed pivot can't be more than a few days to a few weeks away is in our favor. So until next time, ladies and gentlemen, always remember that I love you and I really appreciate you watching.